Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
Moment of truth. Bitcoin trades sideways as altcoins rally and investors anxiously await an imminent breakout to the upside or the downside. Where are prices headed next?
ETH Rotation Imminent. Futures data suggests that traders are beginning to get bullish on ETH, while ProShares lists a short Ethereum futures ETF. What does this mean for ETH?
Important stablecoin updates. USDT's supply hits a new all-time high, Circle closes the door to retail USDC redemptions, and PayPal faces an SEC probe over PYUSD. How could this affect the crypto market?
Risk on rally. Stocks explode after the Fed keeps interest rates unchanged for a second time in a row, foreshadowing rate cuts on the horizon. Everything you need to know.
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, BTC traded almost perfectly sideways in the 34 to 35k range. The only exception was Wednesday, when BTC basically touched 36k, a move that turned out to be a false breakout to the upside. The catalyst for this fake-out seems to have been the Fed, but we'll come back to that later. Now, it appears that BTC's relatively static price action caused a small but significant rotation into altcoins. This makes sense considering that when BTC gets boring, investors go further down the risk curve looking for bigger gains. This typically begins with a rotation into ETH, but this time was different. This time, investors began by rotating into speculative cryptos like meme coins before rotating into layer 1 cryptos with actual fundamentals. What's interesting is that the cryptos that pumped the most were all layer 1s that had experienced excessive FUD, such as Solana. We'll come back to those later too. Anyways, the rotation into altcoins had two effects. First, it resulted in a sharp decline in Bitcoin dominance, the percentage of the total crypto market cap that's just BTC. If Bitcoin dominance continues to decline, then altcoins will continue to rally. And this ties into the second effect the recent altcoin rally had, and that's that it caused crypto's total market cap to push above 1.3 trillion, putting the entire crypto market on the cusp of a big breakout to the upside. Logically, a continuation of the current altcoin rally could confirm this breakout. There's just one caveat, however, and that's that the continuation of the crypto rally depends on what BTC does. If BTC's price stays roughly where it is or goes slightly higher, then altcoins will likely continue to rally. For context, BTC's price has been bouncing between 34 and 35k since late October. If BTC experiences an explosive rally due to, say, the approval of a spot Bitcoin ETF, then it's likely that altcoins will see losses in the short term. That's because traders will likely rotate out of altcoins and back into BTC to make the most of the rally. The exceptions would probably be BTC-related alts like stacks. And of course, if BTC experiences a correction or a crash, then the altcoin rally will likely come to a screeching halt. As it so happens, BTC's daily chart reveals a divergence between price and the RSI, suggesting that the buying volume isn't there to support these price levels. This is not surprising considering that BTC's recent rally was explosive. It took place over a relatively short period of time. Typically, these kinds of rallies are followed by corrections, but we haven't seen a real correction in BTC's price yet. It's believed that BTC still needs to retest 31k for a full breakout. Now, if you want to trade either of these possibilities, check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and up to $40,000 in bonuses on the best crypto exchanges. This is a deal that's only available to viewers for a limited time, so take advantage while you can. Link is in the description. Now, BTC could easily continue to trade sideways for another week while altcoins continue to rally, and it seems that investors are finally starting to rotate into ETH. This can be clearly seen on the ETH BTC chart, where ETH is experiencing its first sustained rally against BTC since September. In fiat terms, ETH is currently on the brink of breaching $1,900, and it's possible that it's well above that by the time you see this video. As we mentioned in last week's crypto review, a rotation into ETH could result in a BTC-style breakout, which would translate into an ETH price of up to 2.4K, a 20% gain. If this is what we see over the next week, then it will likely mark the official start of a new crypto bull market. This is in part because it would confirm broad participation from all coins and tokens, and in part because it would confirm a clean breakout above that $1.3 trillion total market cap I mentioned earlier. If you're wondering why ETH's participation in this rally is so important, the answer is because a gain in ETH's price will likely result in a rotation into other tokens in its ecosystem. And because most of crypto's ecosystem currently exists on Ethereum, an ETH rally would lift all boats, so to speak. It seems that institutional investors can see this too, because premiums on BTC and ETH futures on the CME are trading at par, according to K33 research. For reference, the CME is used primarily by institutional investors, and premiums show you how much demand there is for certain futures products. The fact that BTC and ETH futures premiums are trading at par suggests that institutional investors are at least as bullish on ETH as they are on BTC, at least at this point in time. What's funny is that K33 announced that it was time to rotate out of ETH and into BTC just a couple of weeks ago. On that note, another crypto company that's been keeping track of institutional flows is CoinShares. Now, CoinShares has reported consistent inflows out of ETH products, but recently conducted a survey which found that fund managers believe that ETH has, quote, the most compelling growth outlook right now. That's why it's surprising asset manager ProShares decided to list its short Ethereum futures ETF late last week. Some would say this is a sign that institutional investors want to short ETH. Indeed, ProShares probably wouldn't have filed for a short Ethereum futures ETF if there wasn't demand for it. On the flip side, however, it seems that institutional investors have a habit of falling prey to price action just as much as retail investors do. Put simply, institutions wanted to short ETH at the same time everyone else did. By the time ProShares got the ETF approved, ETH had started to rally, and that's the markets for you. Anyhow, the only thing that has us concerned about ETH at this point is its continued weakness against BTC. As promising as the recent rally has been, ETH is going to need a lot more green before it invalidates that bearish breakdown against BTC on the longer-term timeframe. Watch this closely. And if you're enjoying this video so far, be sure to smash that like button to help others find it. On that note, another thing you should be keeping an eye on is the stablecoin market cap. If you watched our video about stablecoin market caps, you'll know that's because changes in them tell you what investors are doing, namely whether there's money moving in or out of the crypto market. As you may have heard, the market cap of Tether's USDT recently hit an all-time high of over $85 billion. For those unfamiliar, the primary demand driver for USDT is trading, specifically leveraged trading. As such, an increase in USDT's market cap suggests there's been an increase in demand for leverage. This is expected given how much the crypto market rallied recently, and what's fascinating is that we saw a similar phenomenon during the crypto bear market in 2019. As you can see, USDT saw a blow-off top in 2018 before collapsing. By the spring of 2019, USDT's market cap had hit a new all-time high. Compare that to the most recent cycle, where USDT's market cap saw a blow-off top in 2022 before collapsing and is now starting to hit new all-time highs. The catch is that a new all-time high for USDT's market cap doesn't translate to an instant rally in crypto. History suggests a lag of up to 1 year. Not only that, but there's another dimension to the stablecoin equation this time around, another stablecoin, Circle's USDC. While USDT's market cap has been hitting new all-time highs, USDC's has continued to decline. In theory, this isn't a problem, since USDC's primary demand driver is DeFi. In practice, however, USDC's market cap appears to have a closer correlation to crypto prices. It only skyrocketed when crypto prices started to rally in mid to late 2020. Compare this to USDT, whose market cap had been rising for almost a year prior. USDC's declining market cap could be a cause for concern. Although it's apparently not a cause for concern for the markets, it's certainly a cause for concern for Circle and Coinbase, both of whom earn hundreds of millions of dollars on USDC's reserves. FYI, USDC and other stablecoins are backed primarily by US government debt, which has been offering high yields. This is likely why Coinbase launched an offshore futures exchange with trading pairs against USDC. Naturally, this would create a new demand driver for USDC that's unrelated to DeFi, a demand driver that has resulted in $85 billion of USDT reserves that are earning Tether a pretty penny. It's also probably why Circle announced that it would no longer allow its retail users to mint and redeem stablecoins. The thing is that retail users probably aren't the ones withdrawing hundreds of millions of dollars of USDC for USD. This is why some are speculating that the real reason could be regulatory. This speculation seems to have some validity given that the SEC still seems to believe that stablecoins are securities. In case you haven't heard, the SEC is reportedly investigating PayPal over its PYUSD stablecoin. There's speculation that this could be because PayPal wants to expand it to other platforms like Venmo. However, it's just as possible that this is because PayPal is using Paxos to issue PYUSD. In case you forgot, regulators ordered Paxos to stop issuing the Binance-branded BUSD stablecoin earlier this year. It's safe to say that PYUSD is conceptually similar to BUSD, which opens the door to similar enforcement. Note that you can learn more about PayPal's stablecoin using the link in the description. Anywho, it seems that the correlation between stocks and crypto is starting to return. That's because the stock market finally experienced a recovery rally last week. As I mentioned earlier, this recovery rally was in large part due to the Fed's decision not to raise interest rates for the second time in a row. This begs the question of whether the Fed has officially paused. The answer seems to be yes. Now, this is partially because investors are currently pricing in a pause for the next few meetings. It's also partially because the Fed has made it clear that long-term interest rates have been doing the heavy lifting. This is a bit odd considering that long-term interest rates fell after the Fed made these comments. If you look closely, though, you'll notice that the long-term interest rates fell a bit before. This was probably because the Treasury Department announced that it would issue less long-term debt than expected. To clarify, short-term interest rates are influenced by the Fed, whereas long-term interest rates are influenced by the free market. The price of US bonds is ultimately what determines the long-term interest rate, and the price of US bonds is determined by basic economics, supply and demand. The Treasury's decision to issue less long-term debt therefore resulted in a bond rally, but there could still be more to the story here. Now, the elephant in the room is the conflict in the Middle East, which hasn't yet escalated despite many close calls. This has almost certainly contributed to the stock market rally. At first glance, the decline in bond yields could be a sign of a flight to safety among investors who are concerned about an escalation in the Middle East. Upon closer inspection, however, no escalation means less US government spending on the military. That means less US bond selling, which is bullish for bonds. That's macro for you. But anyway, back to the Fed. Now, if the Fed has paused, and they likely have, then this is more bullish than you might think. That's because the Fed has historically only managed to pause for about 5.5 months before being forced to lower interest rates in response to an economic crisis or the financial system breaking. If you count the last two skips as being part of the pause, this means there's only around 3 months left before the Fed is forced to cut. This would put the first cuts sometime in January. Conversely, if you start counting from the most recent meeting, that means that the Fed could start cutting in the spring. This would be extremely bullish for risk assets such as crypto. That's because it would forecast more rate cuts to come. If the Fed does indeed start cutting in the spring, then it could coincide with the listing of a spot Bitcoin ETF, assuming the SEC decides to delay the applications until the last minute. And of course, there's the Bitcoin halving to keep in mind too. There's just one other thing to keep in mind, and that's that the Fed only ever starts cutting when something has gone horribly wrong. In practical terms, that means that a Fed cut will only happen when the markets are in freefall. Look no further than the pandemic flash crash for evidence of that. Speaking of which, if the pandemic flash crash is anything to go by, then emergency cuts by the Fed would probably be met with a muted response from the crypto market at the outset. It would likely take a few months for liquidity to really kick in. If the government responds with fiscal stimulus again, well, get ready to rally. Now, with all that said, it's about time we looked at last week's top-performing cryptos. So, take it away, Jessica.
Thanks, Guy. Well, last week's top-performing cryptos were PancakeSwap, Multiverse X, Neo, Thorchain, and Immutable X. Starting with PancakeSwap, its Cake token appears to have pumped on the news that the DEX will be undergoing a significant upgrade later this month. PancakeSwap also partnered with another DeFi protocol called Brill to bring on-chain portfolio management to its users. Cake appeared to be squeezing to the upside on the weekly chart, but faces lots of resistance around $2 to $3. It's also still well below the Bollinger Band moving average on the monthly. Now, this will make sense considering that Cake has an aggressive inflation schedule. Think constant sell pressure. Next up, we have Multiverse X, whose EGLD coin appears to have pumped due to South Korean investors aping into the altcoin. To put things into perspective, over 60% of EGLD's traded volume over the weekend came from Upbit, a South Korean crypto exchange. In similar fashion to Cake, EGLD appears to be squeezing to the upside on the weekly chart, but appears to have been rejected by the Bollinger Band moving average on the monthly. EGLD also faces significant resistance around these levels, specifically between $40 and $50. As for Neo, its Neo coin appears to have pumped on the news that the crypto project will be introducing an EVM-compatible sidechain. Neon founder Da Hongwei noted that the testnet will launch by the end of the year. It's safe to assume that any upgrades along the way will be bullish for Neo. Believe it or not, but Neo is looking extremely bullish across all timeframes. The most important timeframe is the monthly, where Neo appears to have closed above the Bollinger Band moving average. If it can keep up this momentum in November, it could squeeze to the upside and continue to rally. When it comes to Thorchain, its Rune coin appears to be pumping since the cross-chain DEX relaunched in early October. Recent posts on Thorchain's Twitter reveal the DEX is offering yields of up to 440% on stablecoin liquidity providers. Not financial advice, but be careful with such high yields. Now, in similar fashion to Neo, Rune is above the Bollinger Band moving average on the monthly and could be on the brink of squeezing to the upside. To be honest, this is one of the most bullish charts we've seen for any altcoin in recent memory, but it is unclear why Rune has been pumping so hard. In any case, the last crypto on the list is Immutable X, whose IMX token has been rallying ever since the crypto project announced a, and I quote, collaboration with Amazon Web Services in early October. Unfortunately for IMX, it's not looking too hot on the charts. It faces lots of resistance around the $1 mark and is on the brink of being rejected by the Bollinger Band moving average on the monthly. With some luck, the weekly squeeze to the upside will continue and we'll see a break above resistance by December. Now, if you want to know why cryptos are rallying and also where you can trade them, you'd be sure to check out the Coin Bureau Telegram channel. The link will be down in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you do want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to that resource and many others in the description below.
Thank you so much for watching. We'll see you all next time.